Good afternoon, everyone. I am Patricia Alba, Assistant Director of Communications and Work Life at UFHR. Thank you all for joining us for today's webinar on homeownership with IFAS Duval County Extension Agent Natasha Parks. Before we get started, some housekeeping items. So this webinar is being recorded and will be uploaded to our Work Life website and our YouTube channel. You are welcome to turn off your cameras if you don't want to be shown in the recording. Natasha will take questions at the end of the webinar, so please feel free to post your questions in the chat to be answered. Finally, please make sure that your microphone is muted so that we avoid any interruptions during the presentation. So with that said, Natasha, the floor is yours.
Thank you so much, Patricia, and thank you so much for having me. So there are some things that you need to know before purchasing a home, right? And I want you to kind of make a mental check. If you want to put it in the chat box, you can, but I'm going to go through these questions. I'm going to read them because I think they're important, and it's just so you can resonate. You can think about these topics. So 1, do you have stable income and employment? Take a mental note or put it in the chat box. Will you remain in the same location for a few years? Are you effectively managing your budget? Do you have an established credit history? Is your credit history favorable? Have you planned a new budget so you can know what you can afford? Do you consistently pay your bills on time or even before the due date? All right, Janelle, I see you shaking your head. I like this. Will you remain in the same location for a few years? Is your debt low enough so you can qualify? If not, can you pay down your debt prior to purchasing a home? Have you checked out all the first-time home buyer financial assistance programs? Okay, so just so you know, whenever you're searching for a home, a lender needs to know what you can afford, okay? And when they say, what can you afford? They're talking about your gross monthly income and your monthly debts. I want you to think about this for a minute. Gross monthly income. Do you know the difference between net and gross? I'm quite sure you do. But to me, and I'm just going to put this out there, if you're going to determine how much I can afford, why are you using my gross when my net is something completely different? Because that's what I bring home. I just want to put that out there. Just think about it, okay? So what they use to determine is this formula. It's called debt to income ratio. Have you all heard of this before? Yeah, no? Okay. So your debt to income ratio, it takes your recurring monthly debt and put that over your gross monthly income. So for example, this person, between their rent, their car, their student loan payment, their credit card payment, they have about $2,600, right? Now, here's another mental note. This is what's being reported to the credit bureau, okay? Those are the only debt expenses that I'm talking about. Now, they divide that by $5,500 because that's their gross monthly income. And they come up with this percentage. Does this make sense so far? Yeah? Okay. Yes, everybody's saying yes. Okay. So you might say, well, what does that percent mean? So this is what it means. 35% or more or less, you look good to the lender, okay? Your debt is at a manageable level. But if you're at like 36 to 49%, there's room to improve your debt. So you need to consider some options that will lower your debt to income ratio. Can everyone see the screen pretty well? So right here at 20%, it says you are close to or in the danger zone for debt. That means your debt level is too high, okay? But let's jump over here. If you're at 15%, you are probably in pretty good shape. But if you're 10% or lower, you probably have very little bills, okay? Does that make sense to everyone? You want to give me a check or put something in the chat box? All right, you got it. Okay, good. So let's take this to another step. There is a housing affordability calculator, and it's by NerdWallet. There are other ones out there, but this is the one I want to focus on right now. So I'm going to circle some things on this screen, right? So this particular person, monthly payment is going to be about $2,500, right? They can afford about $304,610 mortgage. And it shows right here that their income and expenses is about $2,667. Their monthly income is about $8,300. So this says that your debt to income ratio would be about 36%, meaning 36% of your pre-tax income would go towards your mortgage. I just want you to hold on to that thought. We're not going to go too much further in it. But there's another thing you have to think about. This person has poor credit score. That means their interest rate is going to be about 9.489%. All right. Now, for a house of this amount, their down payment is going to be about 20%. That's usually about the range, depending on what type of mortgage you get. So their down payment is going to be $68,233. So, there were a lot of people at the beginning who said, yes, they're ready. My question again is, are you sure you're ready? All right, let's take this a step further. So this is an example of two people with the same gross annual income, but their monthly debts are different. One is $200, one is $400. This is their affordable home price at that amount. What do you all think about that? Okay, just keep the thought. Now, even though we're talking about debt to income ratio and how much you can afford, remember it goes on gross income, not your net. You also have to consider HOA fees and property taxes. All right, look, just hold on to that. We're going to go further. Now, debt to income ratio, we gave you the formula. It does not include your groceries, your utilities, your gas, and your taxes. Debt to income ratio is really the things that are on your credit report, those items. All right. So it's super important for you to have a budget. Some people mentioned about a budget earlier. Now, when I say budget, we have to write down everything because remember, and I know I keep saying this, but I just want to press this issue a little bit more. When they do the debt to income ratio, I'm just going to go back a couple of slides so you can have a visual of what I'm saying. They're talking about recurring monthly debt. This is what's reported to the credit report over your gross, not your net. Okay, so with that being said, let's go back. Look at all these other things on a typical budget sheet, right? If you have a budget, you need to think about Hulu, you need to think about your Netflix. If you have children, you need to think about the money that you give them on the side. You need to think about the money that you spend on birthday gifts. If you go to church or anything like that and you have tithes or offering, or if you like to go hang out with your friends and you cruise and you travel and you do all of these things, all of those things are expenses. So if they're figuring out just your gross monthly income, but your budget is based on your net income, what should you be doing? You should have a budget. Does that make sense to everyone? Yes, I can share the budget sheet. I will do that. I do have the electronic version and we do have some hard copies in the office. So we can talk about that afterwards, okay? So if you have a budget, then you have a better idea of what you can truly afford as opposed to what the lender actually determines what you can afford. Because some people might qualify for a $300,000 home, but with all of these bills, like the ones that we see on the screen, you can't afford it. Does that make sense to everyone? Okay, the difference between gross and net. All right. I know I said I was going to hold the questions to the end, but let's just pull them in now. So you have an agreement with your employer to make a certain amount of money, right? But they have taxes that come out. You've heard of FICA, you've heard of the government. Basically, the government receives their money. I'm not going to go into too many technical terms. But once they take all of these different taxes out and your different premiums and your pre-tax things, Once they take that out, whatever's left over is what you're actually going to receive. So say, for instance, if you get direct deposit, you might make gross $3,500, right, for one pay period, but you're actually only bringing home about 2,000 because of all of the deductions. Does that make sense to Nia? Okay. Yes. All right, good. So everyone understands that part. Let's keep going. So we do have a calendar. This is what I was telling you about. If you're interested in getting that calendar, either electronic or you want a hard copy, just let me know and I'll give you my email address at the end. So we talked about DTI and I didn't cover that much about it, but you get the point that you need to make sure that you can afford it, not just what the bank is asking for. So the next thing we're going to talk about is the credit score. And when they determine your credit score, they consider these 4 C's of credit. It's the character, it's the capacity, it's the capital, and the collateral. And I'm not going to read everything on the screen, but these are the things that they basically determine. They want to know how long you've been employed, what's your credit history. Some people's like, oh, I have great credit, but you actually don't have any credit. And most people think that since I don't have credit, my credit's good. No, that's not how it works. Let me show you how it works. When you have your FICO score, okay, this is a credit score that they use to determine your credit worthiness. And it goes from poor to exceptional. And these are the ranges right up here. Now, somebody mentioned something about a down payment assistance program. Like usually your down payment assistance programs are handled through the county that you live in, right? And they have varying requirements. Some of their requirements for down payment assistance is to have a credit score of at least 620. So that's in this area. So if you're in this area, you're good. If you're not, you need to work on it. And there's some other reasons why. So if you need to improve your credit score, let's say, for instance, it's in the low area, but you haven't been paying your payments on time. Since it is an algorithm, this is how it's broken down. And the payment history is about 35% and amount owed is about 30%. So you have 65% of your credit score that you can change if you make payments on time and you don't overutilize. So if you have a balance of $100, or let's just say you have a credit card and your limit is $100, we're just using low numbers, right? So you have $100 and you maxed it out. That means that you've spent all $100. The goal is to pay that off before the next statement. If you do not pay that off against the next statement, that means the amount you owed is in this category here, right? You want to limit that to about 20%. But you have to use your credit to improve your credit. Some people's like, oh, I'm just going to use it this one time and I'm not going to do it again. No, you have to continue to use it. Not to mention that they want to see new credit. Like say, for instance, if you just graduated from, you're a freshman in college, right? And you got your first credit card. If you paid it on time, you kept your credit utilization low, you had a mix of new credit, your length of history accounts for about 15% of that, which is a good thing, right? So the longer you have a good credit history, the better it is because 15% of that is included in the entire number. But then there's another little category called credit mix, and that's worth about 10%. So since it's an algorithm, we can't determine how it's going to change. But what we do know is if you do these things, your credit score should increase. I hope that makes sense. If you have some questions, put it in the chat box and we'll talk about it a little later in this presentation. Good credit actually saves you money. The higher your score, the better it is for you. So this is an example of a car. You have a car and it's about $25,000 and you want to pay it off in 4 years. If your credit is low, this is your APR. If it's high, here it is. You see the difference in the monthly payments? Good credit saves about $136 a month, and that's about $6,562 over the 4-year loan. This is no difference than you're getting a home. So if this number was much higher, and these were the APRs, it's going to be much better if you have a better credit score. So when I ask if you're ready, I'm asking about that debt to income ratio and if your credit score is in the right range. Since there's so many different types of loans, they have different requirements for the credit score. But the higher you are, the better off you are. Does that work? All right. So another thing that you need to know about credit, there's these little things that a lot of people don't tell you, but some people think, oh, I'm ready to buy a home. I already have the money, but I need furniture. So what I'm going to do is I'm going to open up a line of credit and I'm going to get this furniture. No, no. Can everyone say no? No, don't do that. You need to avoid opening any new credit within 6 months. Everybody got that? Put it in the chat box, yes, that you got that, because this is super important. Because some people go through the process of getting a home, getting everything approved. They're going through the process, they go to closing, they run another credit check, right? And if that score changes, you may no longer qualify because your score dropped, because it was based on what they pulled at the time. And then they're going to do it again at closing. Got it? All right. So as it relates to your credit, you need about 2 to 3 lines of credit history on your credit report. Okay. So say, for instance, you have a car loan and you might have a credit card. Okay. So that's what they mean by 2 to 3 lines. Reduce that revolving credit balance below 30%. So that means you do not want to max out your credit card. You want it to be at 30% utilization or less. Does that make sense for everyone? You got it? Got it. All right. Now, when you're shopping for a mortgage, you do it over a 30-day period. And I'm going to give you this example. So I had a car accident a while back and I was going to get a new car. And I went to the lot, I found a car. And then my husband realized that he wanted a new car as well, right? So we were going to put the cars in his name. And the guy, he was like, you sure you want to get another car? And he was like, yeah. So what happened was when we got the new car, it was only accounted for pulling our credit only one time. I'm gonna pause there and give you this other piece of information. Usually when people shop for cars, they might go 1 week and they'll have someone pull their credit, and then they'll go somewhere else and have someone pull their credit, and go somewhere else and have someone pull their credit, right? If you do it all in one place and over a time frame, especially with cars, it's usually within a month. It won't hit your credit badly, meaning there's something called hard inquiries and there's something called soft inquiries, right? The more hard inquiries you have, the lower your score goes. So it can be somewhat complicated. I'm giving you a very condensed version. There are more pieces to it. If you want to know more and you have questions, go ahead and put that in the chat box, or I'll give you my email address so we can talk about that more. But my point is, if you're gonna shop around for a mortgage, you're gonna do your research. You're gonna try to find the best rate that you can, but the only way you do that is once they pull your credit. After that 30-day window, then it starts acting as a hard pull, if that makes sense. I hope that makes sense. If it didn't, I'll give you clarity in just a moment. Also, we have multiple pulls. That's what I meant by the multiple pulls by your lender will count as one pull within that 30-day window. Okay. I hope that makes sense. I hope I didn't confuse you on that one. So the question really is, are you ready to purchase a home? We talked about a lot of different things, and I know I haven't spoke that long, but I think we're going to have more questions than what I'm actually want to present, because it's not just like, I'm ready, I got to get out of this apartment, I got to get out of my parents' house, I got to do this. Are you managing your finances correctly? Do you know what your debt to income ratio is? Do you have a budget so you can truly know what you can afford? Does that make sense? All right. Did I confuse anybody? Did I make anybody mad out there? Are you now upset because you were ready and now you realize that you're not ready? Because that's actually a good thing, because you don't want to be house poor, okay? You definitely don't want to be house poor. All right, so I'm going to open the floor to questions. Carolyn said, she said it makes sense and she is super ready. And Abby said this information is helpful. We actually have a first-time homebuyers class. Our next class is actually tomorrow night from 5 to 10. A lot of people who participate in down payment assistance in the county, they have different requirements. So since we're a statewide team, we do a virtual session and they're required to participate in 8 hours. So we break it up into 2 sessions. Usually we have a session on a Thursday from 5 to 9 p.m. and then we'll have another session the following Thursday on a 5 to 9. And then also we have sessions where we do it from 9 to 1 on a Friday, and then the next Friday you'll do it 9 to 1. Does that make sense for everyone? And down payment assistance is different for every county. I'm in Duval County, which is Jacksonville, Florida. So with us, it's not really like they're giving you money. They're actually applying for a second mortgage. And if you stay within the home for 5 years, then what happens is you don't have to pay it back. But it is technically a second mortgage. You can get up to $15,000 in down payment assistance, but it goes by income, family size, and there are some other requirements. For Jacksonville, Duval County, their requirement for the credit score is 620. Now, at the end of our sessions, we normally give a certificate of completion. And that certificate of completion is needed for your paperwork for down payment assistance. In Duval County, that certificate is only good for a year. In some of the other counties, it's good for more than 1 year, like 2 years. It is also dependent on what's available in the county. And I think it was another question I saw somebody say. And yes, anyone can attend these particular sessions. It's virtual. We usually have them once a month. Again, the next session is starting Thursday at 5 p.m. I don't think it's too late to join, but we can talk about that in a minute. So I do see some.
We have a couple of questions and I can run them by you.
Thank you, Patricia.
Sure. So the first one that came through is, how does the lender consider student loans in the calculations?
Ooh. So I'm going to ask you a few questions. Is your student loan on your credit report? Usually it is. So if you have a student loan and it's your credit report, that's going to be factored into your monthly payments. Some people who are in default with student loans, they really have harder times getting approved for a mortgage. And it depends on how much you owe, where your status is, what the lender is going to allow, etc. Is Johanna on the call? Because she has a lot of knowledge about student loans.
Yes, I'm
There
here.
you are, honey.
I'm here. Hi, everyone. How are you? I'm Joanna Gomez, and I'm the extension agent in Osceola County. So nice to see you all. Thank you, Natasha.
You're
And I
welcome.
saw, before I answered that question, I saw a question that somebody have about the lender. Calculate, if you have to tell the lender how much house you can afford, the lender will calculate that for you. But we want you to know ahead of time or before you go to the lender, because remember, the lender is going to calculate how much house you can afford based on your gross income, like Natasha was telling you. So when they use your gross income, they are not using what comes to your pocket or you receive in your check when you deposit that in your bank account. They are using your gross before any discount. So actually, the number that you're going to get in that pre-approval letter for a house that you can afford is going to be based on that number. So it's very crucial that you know how much house you can afford, and you take into consideration that that number probably is a little bit more elevated than the house you can afford in your net income. So make sure that it's good to know before you go to your lender, but the lender is going to calculate that for you. We were talking about the student loans, and student loans, it depends on how much student loans you have. Some lenders tend to use a 1% of the debt that you have in order to calculate that as part of your debt. Some other lenders have other rules. It's very important that when you talk to your lender, They're gonna see in your credit that you have student loans. They're gonna ask if they're deferred or they are at that moment you're making the minimum payment. So they're gonna ask what is the situation of your loan at that moment, so they can calculate that into part of your debt when they are gonna calculate your debt to income ratio.
Thank you so much, Johanna, because you know that's your expertise with the student loans. That's not my area.
Well, it's an area that depends on the lender as well, because some lenders have different guidelines. So that's what's very important when you're working with your realtor, you're working with your lender, and you're working with the professionals that are involved in the process for you to ask questions. These questions that you're writing here are excellent. So that's important that you know also what to ask when you're starting the process of purchasing a home.
Thank you so much, Johanna.
You're
Okay,
welcome.
the next question we got was, should I use credit cards less and use debit card instead so that it doesn't get reported as monthly debt?
So it depends. That's a kind of loaded question for me. And what I would say is, if you have credit cards and you're trying to get a house, you need to reduce your overall debt. It doesn't matter if you're paying with a debit card or not, but you have to think about it. A lot of people use credit card for large purposes. That's one way people use it. Another way that people use credit cards is that when they get paid, they pay their bills with their credit card if they can. And then before the bill is due, they use their paycheck to pay down that debt to get back to a zero balance. That's another strategy, okay? It's basically a strategy. The way you do it is how you do it. So the answer is not, do I use my debit card to pay down my bills? It's about, what are you using your credit card for? And what are you using your debit card for? And which strategy you're going to use. Because neither one of them technically determines if you're going to get approved for this mortgage. It's more or less, is your debt to income ratio low? And on your personal management side, how you're using your credit. I hope that answers your question and that made sense. Did you want to add anything to that, Johanna?
I want to add something about the credit cards, because I see another question about reducing your credit card number. And I don't know if you're talking about the number of credit cards that you have or the balance that you have on your credit card. There are two different things that the lender looks when they are looking at your credit card. They're going to look at the balance that you have and your monthly payment on that balance. Why I say this? Because remember, when you're purchasing a home, when you don't close the number of credit cards that you have. You have built a history, like Natasha was talking about. You have built a history that they can look how good of a consumer you are paying those credit cards. So it's very important that you keep those credit cards open. What you're gonna try to do beforehand or before you start the process, if that your balances are too high, making your debt to income ratio too high, you're going to start trying to make an extra payment or try to reduce that debt. So when the lender look at it and the lender just say, okay, this person is ready to purchase a home, let me see what is the debt to income ratio. Yes, he has 3 different credit cards, but the balance on these credit cards are lower than a 30%, like Natasha was saying. That's the impact that it's going to have. So I think it was Aubrey, if I'm not mistaken, you asked about that credit card number. Don't reduce your credit card number. You leave your credit cards open if they're in good standing. Just try to reduce the balance that you have on those credit cards so your minimum payment can go low. Okay?
Never close those credit cards.
Never close. And it was Nicole.
Very...
Thank you, Nicole, for that question. Never close a credit card, because let me tell you this, your FICO score is gonna drop significantly.
Significantly. And it is a very old culture where people would say, oh, I want to reduce my debt. Let me pay this off and close it. Let's put in the chat box again. No, we're not going to do that. So everybody put in the chat box. No, we do not close credit cards. You still use them, because remember, the length of history is important. That determines your score. All right. You all did say no. Thank you. Thank you. Thank you. We do not close credit cards. All right. Go ahead, Patricia. Thank you, Johanna.
So kind of following along the same lines, though, somebody mentioned that they thought opening new lines of credit hurt your credit score, so that I haven't done that in many years. And now they're asking if they should apply for more credit every so often.
So let me go back to this slide. Yeah, there it is. Can everyone see that?
Mhm.
Yes.
So remember, Johanna was talking about the Lithium history. 10% of that algorithm is new credit. So I'm not going to say how often it should happen because I haven't seen any evidence stating that it should happen every 5 years or whatever the case. Have you seen that, Johanna? Because I haven't seen anything like that. But the
No,
point
me
is,
neither. I haven't seen
you have
it.
to get new credit over time, okay? I'm not going to say every 5 years. They just want to just know that your score is reflected 10% of that algorithm based on new credit.
And I wanted to add to what Natasha is saying about the 10%. The 10% is not much, but what is suggested, for example, if you're purchasing a home, and we know when you're buying a home, you want to buy new furniture and you want to buy new pots and pans for your kitchen, and you probably open a new credit because you go to Rooms to Go to buy some of the furniture that you want in your home. When you acquire a new credit card, even though it affects your credit, that minimum 10%, remember that it's important the balance that you're adding to that new credit, because that's going to add to your debt, and that significantly is going to take up a toll on what you qualify for. Why? Because that new credit that you open, let's say that I just say, oh, I'm going to close in 2 weeks. I want to start buying the furniture. I'm offered 0 interest for 18 months if I buy the furniture in XYZ store. You go open that, and a day before closing, guess what the lender is going to do? They're going to check your credit. And when they pull your credit, they're going to see if you have new credit and what is the balance of the new credit. So open the new credit is not affecting your credit score that much. Over time, you will recover those points. But when you open new credit and you add to that credit a balance that is high and goes above the 30%, then it will create a problem on your debt to income ratio because it's going to go high and it can disqualify you for your loan.
Which means you must have a budget. So if you're planning to buy a home and you know you want to have this furniture, start putting money aside for that, okay? Instead of opening up that new credit. Thank you, Johanna. Do we have any other questions, Patricia?
Yeah, we do have a couple.
Okay.
The next one is, how do credit scores work with a spouse? Do they average out their credit scores?
That's a good question. And the best way I can answer that is your spouse going to be on the mortgage? That's really the gist of it. So when we have that first-time home buyers, a lot of people come to the class and they're like, oh, I'm going to do down payment assistance. And we ask them, well, who's going to be on the mortgage? And a lot of them say me and my spouse. And then we tell them that both of you all have to participate in the class. Both of you all will receive a certificate. Both of you all's credit score is going to be taken into account when you go to the lender. Does that answer your question? I'm trying to keep it simple without getting too technical about it.
Yes, thank you.
You're welcome.
Okay, so the next question is, someone mentioned that they stopped using credit cards years ago and some have been closed by the company. So does that hurt their credit when they didn't close them, but the company closed it?
Yes, it does hurt because it's now a closed account. Your scores are usually going to drop, but that doesn't mean that you can't recover from that. What was the thing that Johanna, that Lisa was saying, that if your account was closed, you have a time frame to either dispute it or try to reopen an account? Do you know what I'm talking about? I can't remember what she said about that.
Yes, when you have an account that is being closed by the creditor, you can dispute that as well. Or because sometimes you don't have activity in X amount of month, the creditor just closed that account. It affects your credit. It's not as much of an impact, but sometimes it's the decision of the creditor to close it because you haven't been using it. So what is recommended is that if you have a credit card and you don't use it as often, at least make every month or every so often a small purchase, just to continue having that. Also, some creditors, if you don't use your credit card, they tend to reduce your credit availability. So let's say that I have in a credit card $2,000 available, but then for some reason I said I stopped using that card, and my creditor sent me a letter, your credit has been reduced, or your credit availability is only $1,000 now. before it used to be 2,000 because I'm not using that credit card. So it's very important that when you use credit card, you have a time frame. I think it's 30 to 60 days if it is closed. And when you receive that letter from your creditor closing your account by the creditor, it tells you what is the reason why. And it gives you X amount of days and the explanation who you can contact if you have any questions regarding that closing of that credit card.
Thank you.
Okay,
Okay.
so somebody asked for clarification. When you say avoid opening new credit, does that include refinancing a car?
Yes, that's new. Yes.
While
That-
you're in the process of purchasing, it's just good to be stable and paying your debt the way you've been doing it. So no major changes occur while you're binding in a contract that you submitted your contract for your purchase of your home up to the end of the closing, because remember, at any time, at any point of the process, the lender that is lending you the money to purchase the home can pull your credit. And when they pull that credit and they see something that is new, it can affect your credit score. It can affect your debt to income ratio. So that's why we say maintain consistency once you start the process of purchasing your home in your credit. So you avoid that, what Natasha was saying, you avoid that point of the lender being just, oh, this client may be now at more risk because their debt is higher. So make sure that you use your credit wisely while you're doing your process of purchasing your home.
Mhm.
Do lenders do a hard pull or a soft pull on our credit?
Hard,
Hard.
hard.
Which agencies are reliable to pull a credit report? Just like a website, isn't it, for all three?
Yeah,
Annualcreditreport.com.
yeah.
If you want to put your credit report and see what is in there, is the one that we always recommend to use. So we can put it in the chat. I'm going to put it in the chat. If you want to check your credit report and what is in there, you can pull your Equifax, TransUnion, or Experian credit reports from there. And it's free. Once a year, you can pull your credit for all the 3 credit bureaus, and it's free of charge for everybody.
And remember, your annual credit report is for your report. It is not for your FICO
For
score.
your credit,
That
correct.
is different, right? So we usually say that the first step to improving your credit is pulling a credit report because you need to see what's on there. For example, a lot of times when people don't pull their credit report, they have no idea what's going on. My brother and my father have the same first and last name. My brother had things on his credit report that were my father's. It didn't really affect him because his credit was good, but it shouldn't be on there. Does that make sense? So those are those things that we can talk in more detail about, those other factors as it relates to credit. I think another question just popped up, Patricia, did it?
Yeah, we have a couple.
Okay.
Why does a hard pull hurt your credit score?
Say that again?
Why does a hard pull hurt your credit score? Like soft pull versus hard pull, why does the hard one hurt your credit score?
Okay, so let's kind of define the difference between the two, right? So when you talk about a soft pull, say for instance, you want to go get an apartment. And you're not applying for credit for apartment, right? You're just trying to get this apartment because you're going to be paying a monthly fee. A lot of times they do a soft pull on that because they just want to see your credit history, right? So you can have only so many per month that where it doesn't affect you, et cetera, et cetera. But the hard pull is really, they're really trying to see your credit worthiness and if you can pay this and see what you've been paying and how you've been paying. It's basically more of your behaviors and practice. So once they do that, that's, for example, and I hope I'm not confusing you. Say, for instance, you wanted a credit card, because this might be a better example, and someone denied you. And then you went to another company and asked for a credit card, and they denied you as well. Then you went to a third company and they approved you. That means that you got 3 hits on your credit report because each time they pulled your credit, that was a hard inquiry that is going to negatively impact you. That's the best example I can give without giving all the other details. So every time you do a hard pull, meaning they're actually pulling your credit because you're applying for some type of credit, which is going to be on your credit report, is more of the hard pull. The soft pull is more like if you're going to apply for apartment or if you're going to apply for a job. You know, a lot of times jobs do like a credit check. That's what they're doing is a soft pull.
Okay.
And also some creditors will monitor, your credit to make it, how many of you receive an envelope in the mail saying you're being pre-approved for something?
Yes,
You've been pre-approved for this credit card or this loan. Those are soft pull. Why? Because
yes.
credit companies and creditors will just monitor softly your credit to see how good you are of a consumer. And then they will send you these offers on the mail or via email that you receive to apply for those credit cards or those loans. So that's another part of what Natasha was explaining. That's a soft pull. It's not going to affect your credit. It's just being monitored in order to make an offer to you. So most of the soft pull is not something that you request. It's just done by the third party that you didn't sign an authorization for them to pull your credit.
And that's a good point, Johanna. I forgot about that one. And also, sometimes when you have certain credit cards with certain companies, and they'll send you an email or something in the app and says, "Do you want to increase your balance?" Like if they're going to give you an increase, sometimes they'll do another hit on your credit just to get that balance, that new balance. So there's so many different things with credit that, there are things that little tips and strategies that everyone in our group really knows. And then some people know more than others, but there's so many different things. It's kind of hard to wrap it up in this one session because there are other factors involved with credit.
And Patricia, I see 2 other questions in the chat.
The next one is, how would we find more information on down payment assistance?
It's based on your county. We can kind of help you with that because I think someone else asked about down payment assistance and they wanted to inquire about it. We need to know your county so we can give you the proper information. Remember, we have a statewide housing team and we're basically represented in about 30 counties. So we have agents who teach different portions of that 8 hours of education that I was telling you about. And part of it is that down payment assistance. So we try to give you a little bit more information as it relates, direct you to the agent who helps you in your county.
And I dropped a link in the chat for the for Gainesville people, the down payment assistant training workshops that the city of Gainesville hosts.
So what I can do is send Patricia an email with the link to all the agents in the counties that they work in so you can have a contact person.
Yeah, that would be great. And
Yeah,
we'll
I'll do
post it
that.
on the Work Life website for everybody. What is the purpose? Oh, okay, so that's right. So you mentioned the workshop that you're hosting and that you give a certificate at the end of that workshop. But people want to know, what's the purpose of that certificate? Like, what is it good for?
So we're a HUD-approved agency, and a lot of times when you're doing any type of rental assistance, down payment assistance, they want you to go to a reputable place where you get those 8 hours of education. Of education. So the requirement for the down payment assistance is to have the 8 hours of education. Therefore, we give the certificate as proof that you had those 8 hours of education, so you can use it for your requirement.
And I see another question on that same line. And yes, you can attend the class, you can attend the workshop, regardless if you don't qualify for down payment assistance, because we also teach the process of purchasing a home. And we go step by step on all the steps that you need to take in order to purchase a home, the contract, the professionals involved. So if you want to acquire the information, you can attend the class, you're gonna receive a certificate. It doesn't mean that you need to apply it, or if you don't qualify for down payment assistance, then you don't use it for that purpose.
Yeah, because you learn so much more in this class. I mean, it's 8 hours. So each agent kind of does a great job. We actually have lenders and realtors on the calls, so you can learn a lot from them. They do their own presentations as well. So I think there's a lot that you can benefit from this class. We even go to the housing maintenance. They talk about pest and HVAC systems and what you need to look for before you start purchasing a home.
Okay. The next question is, if I close a money market account that I've been using to save money for a home, will it impact my credit score?
No,
No.
because you have to think about money market, that's income. So that's separate. That's not on your credit report.
Okay.
Is-
The next question is, if you have owned a home in another country but have never been on a mortgage in the US, does this count as a first-time homeowner? They included that they are on the deed, but not on the mortgage here in the US.
Now, do you know about how it works internationally? I don't know that. I do know that you can't own a home within 5 years to be considered a first-time home buyer in the US.
Correct.
But
To
I
be
don't know about the
To be
international.
considered a first-time home buyer, you need to be out of a title for that 3 years period or more. And if you own a property outside the United States, that's something that you will have to ask the program if they would allow that to happen. Also, people sometimes ask us, well, I'm in the title with my mom and my dad, but the house is not mine. They just put me in the title just in case something happened to them. Once you're in the title of the property, you become a homeowner. So make sure that if you are in a title because of you have a relative or your mom and your dad, it makes you a homeowner once you are in that deed. So that's a very good question for the program. Some programs would allow people to have a second home outside the United States, but some other programs are very strict about being a first-time home buyer in the United States. So you need to ask those questions to the specific programs because every programs were different in every county. So take that into consideration when you're looking, if you're looking to use down payment assistance for any of your, when you're gonna purchase a home.
People are wondering how can they attend the workshop that you mentioned for Thursday? If you have a link, you can drop on the chat for them to register for that.
So what I'm going to do is send Patricia the link of all the agents because it depends on which county you are in. Is everyone in Alachua County who's on this call?
No, I think we have people from here, from Jacksonville, and even from Orlando, based on the registration.
Okay.
So, yeah, we have
Okay,
them all over.
so I will put in the website for Jacksonville and then I'll send you the link for the other counties, okay? Johanna, who's the agent in Alachua?
I think we're covering Alachua because I think it was Martha Maddox.
Yeah, but
But I think we are just covering that with the registration for the main registration that we have.
yeah. Okay.
Yeah, we're covering that one with that.
Okay. So here is the site for Duval. And just give me a second. I need to pull up the other site for Volusia County, which will handle Alachua. Do you know her Eventbrite page off the top of your head, Johanna?
No, by the top of my head, but I'm looking at here. Let me
Okay.
see if I can find it really quick.
Did you have another question, Patricia, while Johanna's listening?
Yeah, so is there an expiration date on attending the education classes? Like, is there such a thing as attending a class too early?
No, it's not. Well, it depends on the county. So remember when I was saying like in Duval County, if you participated in the class, you have basically a year to use that certificate for down payment assistance, right? But that's only if you're using it for down payment assistance. Some of you all might be in a case where you can get a conventional loan because your credit score is at a certain place and you don't really qualify for down payment assistance. You don't necessarily need a certificate for that. The class is really for education purposes for those who want to learn about the home buyers process, but also it's for individuals who need the certificate for down payment assistance.
So following along those lines, what is the income limit for down payment assistance? Or
It
does it
depends.
vary?
It depends on the county.
Right.
It really depends on the county. So everyone is different. Every county is different. Let me pull it up for Duval County just to give you an
Let me see if I
idea.
can.
What is yours in Osceola County, Johanna?
For what?
Down payment assistance, the income limit.
Down payment assistance in Osceola County is based on the median income in the area, the average median income in the area, and they have a table. They're actually open in, I think, May 1st. So they will have the new guidelines, and it is provided by the CHIP program in our county through the Department of Housing. So I can put that information there if I have some, but it depends on the county. Some counties have it through the city, some county has it through the county office for housing. So I would just suggest that if you are looking into purchase a home using down payment assistance, sometimes the funds are not open, they open later on in the year, or they may have rolled it over for the next year. So just make sure that before you apply for any loans, if you're looking for that down payment assistance, you check in the county that you're buying in. Some counties also give preference to the people that are residents already in that county. So let's say, for instance, that I have someone that comes to Osceola from Orange County or come from Seminole County. They give preference to the residents in Osceola County first, and then they consider those other applications. There are other programs that they don't mind where you come from. You don't need to be a resident in the county to just get the down payment assistance, or they don't give you that priority. So make sure that you ask in your area how that's coming to play with the department that is offering the down payment assistance.
And I think we only have like 6 minutes left, but I did put a link in there for Duval County. And just to give everyone an idea, a family size of 1, your maximum gross income has to be 80% of the median, and that's $49,600.
Correct.
And then on the
So-
larger size of the family of 8, your maximum gross would be 93,500. But you also have to pay, there's more to it. I'm not going to go into that for the sake of time.
And then we have a question with Arkin that says, is all that DPA repayable, or do you offer grants? And that's another question that we get. Most of these grants, or most of these down payment assistance programs, are a second lien on your mortgage. So it's a silent mortgage. You don't pay on it, but it's restricted that you need to live in the house as a primary residence for X amount of years. Some counties are 5 years, some counties are 10, some counties are 15 years. And once you live on that period of time in the property as your primary home, those down payment assistance and that second lien mortgage that is being put in place with your first mortgage is forgivable, or you and you don't have to repay or pay it back. Some other ones are grants that you do have to repay, like the Florida bond that is across the state. And when you have the Florida bond, yeah, anytime you sell the house, you need to return that money back to the agency that provided that fund to you. So it depends on the funding that you're using. So that's a very valid question to ask when you're applying for down payment assistance. Make sure that you ask them, hey, is this down payment assistance program repayable, or is it grant and I don't have to pay it after I live in the house X amount of years? So thank you for that question.
Okay, I don't see any more questions come through. Let me see real quick. Let me check real quick that I didn't miss anything. Okay, so somebody just answered. So, for people over 50 who are alone but want to buy a home, is there any option?
Not that I have heard of.
Yeah.
It's just the same they will use the same tables, they will use the average median income in the area on that county for you to qualify for any assistance.
And you've kind of already answered them, but somebody asked again, can I refinance my car during this process?
We will not suggest that, because
No.
when you're gonna refinance your car, they are gonna pull your credit, and once they pull your credit and they see that you're doing something, your FICO score probably will go down a little bit, and also they will see that you're doing something in the process. So if you're gonna do it, we suggest to do it beforehand. Just do your refinance and everything, wait at least 3 months, 4 months, and then just, start the process of purchasing a home. I'm not gonna say never, because never is a big word to say, but remember, when you're in the process of purchasing a home, any changes, minor or big, can have an influence on the decision of that loan to close. You don't want to get to closing, and my prior appointment, I was a loan officer, and I remember having people applying for furniture, and then when they were gonna close, the lender said, no, you now are out of the debt to income ratio is too high, we cannot close this loan. And you've been in the whole process, and then at the end you cannot close. That is very discouraging and disappointing after you go through all that. So we'll suggest don't make many changes or big changes in your credit when you're in the process of purchasing a home.
Okay, remember that we also said earlier, put no in the chat box. We're not going to do that. We're not going to open up any new loans during that process. So everyone put no, just to finalize that.
Yeah,
point.
no refinance, no new credit cards,
Thank you,
no new
Carolina.
anything until
Thank you,
you close in that home. Not that you're gonna go after you close the loan and just open everything, but at least don't do it during that process. Is the recommendation from the experts. On the literature that we have read.
Okay, well.
Did you
I
all learn
honestly-
something today? Oh, I'm sorry, Patricia.
No, go ahead, please.
What are two things or one thing that you learned today besides the no credit, no opening new credit?
Down payment assistance.
Okay, down payment assistance, good. Debt to
Debt to income
income, don't close your
ratio.
credit card, good. Okay, good.
Net
So you
versus
are learning
gross.
something. Good, nice.
Nerd wallet.
Gross is considered, okay, not net, good, Sophia. Education first, buying later, good, Heidi. All right, good. Well, thank you so much for having us, Patricia. Johanna, thank you so much for joining me.
Thank you
And
for
being a
having me.
support. We hope you enjoyed this session, and I'll turn the floor back over to Patricia.
Yeah, no, thank you, Natasha and Jonna, for the valuable information that you shared. Before you all leave, I dropped a link to the webinar survey, so if you could all please take a couple of minutes to answer the feedback that you give us, help us plan for future workshops. So
Awesome.
yeah, thank you, y'all. You will get for everybody that joined, you'll get an email in a couple of days with the link to the recording and to the additional, the handouts and other information that was shared today. Okay, well, thank you all for joining us.
Thank you.
Bye.
Thank you. Bye.